If you had the money to buy the things you wanted, would you pay cash for them, or would you take a loan out to buy them? This is a pretty interesting question that would get a lot of different answers. Most people would say, I've saved the money up, I would just pay cash for it because I don't want monthly payments and I don't want to pay interest to somebody else. Other people would say, I would take a loan so that I can keep my money and that opportunity that it presents for me, and I can allow that money to go out and make a higher interest rate. Listen, there's no wrong answer, but it brings me to a really interesting topic: loans. I'm gonna start this episode off with a question. If you wanted to buy something, let's call it a car, and you had saved up enough cash to pay for that car and not need a loan, would you do that? Or would you go out and take a loan out to buy the car so that your money didn't have to be used? Now, if I were to ask a big group of people this question, I'd get different answers. Some people would pay cash because they don't want a monthly payment and they don't want to make interest payments to somebody else. But others would take the loan, or they would say it depends on what the interest rate on the loan is, but they would use the loan and they would then take their money, that's their savings, and send that money out. When I thought about this, it brought up a very unique thing. And that very unique thing is what we do every single day utilizing the infinite banking concept. And that is take loans from our bank. So when we create a private banking system, we're changing one thing, and that is where our money goes first. We're putting it into a specially designed and engineered whole life policy where it earns a guaranteed interest rate plus dividends, and it does all of that in a tax-free environment. But when we have a place for that money to go, like buying a car, we take a loan from the insurance company and then we buy the item, in this case, a car. Some people, when they hear about that, they think that's a terrible idea. Why would you ever borrow your own money? Therein lies today's episode. Today's episode is all about how to maximize your money's efficiency and allow your money to work for you, not just once, but twice. So let's dive a little deeper into this. You got the cash saved up. You've been saving for whatever it is you want to buy. And now you've got it, you could go pay cash for it. But you know when you pay cash for it, that money is gone. And the opportunity cost for that money being gone is something you should consider. What do I mean by that? Well, let's just say you're going to buy a car, okay? If you pay cash for a car, you are buying a vehicle that will depreciate. Therefore, that money that you paid for the car is no longer able to do anything for you. You can't invest it, you can't start a business with it, you can't put that money in treasury bonds earning a guaranteed interest rate. That money's gone, it's sitting inside the car. And the car, in most cases, would depreciate. Now that's the case for most items we buy. We spend money on things because we want them, and most of the time they're worth less when we want to sell them. So what if there was a way where you could just buy the things you want, but you get all the money back for all of them? And it involved you taking loans. Well, that's exactly what we do. You see, when we mimic what a bank does, we have to understand that banks are in the business of making loans. So if we're going to be our own bank and we're going to change where our money goes and put it into an insurance policy, then one of the best things that can happen is taking a loan. You got to understand how a loan works with an insurance policy, specifically a whole life insurance policy. So let's dive into that. First off, we decide how much money we want to put into these policies. We can either do a dump in, like a big chunk of money dumped in all at once, and then decide how much we want to put in monthly, quarterly, semi-annually, or annually in terms of deposits. Kind of like how you do it with your savings account. You decide how much you want to save or not save, and you have the ability to change that amount anytime. Well, the same thing when we create our own private banking system. When we build one of these specially designed whole life policies, we too choose how much money we want the ability to deposit. And that amount can start with a higher amount and it can have a minimum amount. So we call that the min-max. But when the money goes into the policy and when we want to get that money out, this is where loans become really advantageous. So now we got the money in the policy. And now we have a place where we want that money to go work for us. Let's just say you have an investment opportunity that's going to pay you 12%, and the money in your policy is making about 5.5. 12 is better than 5.5. So most people would want to take the money from the policy and put it into the investment making 12, right? Perfect. How we would do that when it's your private banking system is we would take a loan from the insurance company. Now, I want to preface and give a disclaimer. These policies are specially designed and engineered to do what I'm about to show you. And not all whole life policies or all life insurance will do or work this way. You must know that. So before you decide to go out and buy a policy from your advisor or your brother-in-law, make sure that they understand that this has to be a special kind of whole life designed and engineered to do what I'm going to tell you. Now, we found an investment to pay us 12%, but our money is sitting inside of this specially designed whole life. But to get the money out of the whole life, to not have to pay taxes, we are going to take a loan. Now, when we take a loan from the policy, okay, where is that loan coming from? Some people think it's coming from their cash value, but it's not. Your cash value never leaves the policy in a non-direct recognition company. Don't get caught up in that, you can look it up. But when you take the loan, it's actually the insurance company giving you money from their general account. And they're collateralizing that loan with your cash value. You are leveraging your cash value in the policy so that you can get a loan from the insurance company, but the insurance company will never tell you no. They'll never give you a reason why you can't have the money like a bank would, because it's your money. And therefore, you can use up to the amount in cash value anytime you want. But when the insurance company loans you the money, they're literally giving you part of your death benefit, the amount that's paid out the day you die, early. How do I know this? Well, if you ever look at a loan in an insurance policy, the loan comes off of the death benefit. So if you had $1 million death benefit and you took a $100,000 loan, your death benefit after taking the loan is now $900,000 because they subtract the loan from the death benefit. Now, for an insurance company, when they give you that loan, they don't care if you ever pay the loan back. Very different than how a traditional bank or any finance company would work, because they want you to pay the loan back. The insurance company advanced you part of a death benefit that they know they're going to have to pay out someday. Why did they know this? Well, because they contractually guaranteed the day you die that they would pay out a death benefit to your family or your beneficiary of choice. Hence, it's life insurance. So by them giving you your death benefit early in the form of a loan, it's no skin off their back. Matter of fact, it's profitable for them because they charge interest on that loan. By today's standards, this is 2024, January, loan interest rates are somewhere right around 5%. So let's just say the loan that they're going to give you costs you 5%. Most of you, when you hear that, you're like,
I would never take a loan. That's stupid. Why would I put my own money in the policy and then have to pay to use it?
Well, here's why. Remember I said they don't take your cash value out? That's right. They advance you part of your death benefit using your cash value as collateral, which means your cash value is still in the policy, earning a guaranteed interest rate plus dividends. And the interest rate plus the dividends in most of the policies we design, depending on what year you're in, pays you more than the 5% they're charging you. Wow. A light bulb should have just went off. Because you should start thinking like a bank. And that's what banks do, right? When you deposit your money in a traditional bank, the bank pays you interest. Let's call it 3%. But then when you borrow from that bank, the bank loans you money. Okay, essentially everybody's deposit gets loaned out and they charge you more than 3%, don't they? And what do they make in the middle? A spread. If they charged you 6 and they pay you 3, they make a 3% spread. Come back to your private bank, that's specially designed whole life. If it pays you 5.5 and you can borrow it at 5, your gross spread is 0.5%. But since your money's still in the policy, still compounding at that same interest rate uninterrupted, the next year you have more money compounding, and the next year it's more, and the next year it's more and more and more. And every time you compound up, that means that you have more money earning that interest rate, which essentially means your spread goes up. Because if the rate that they're charging you to borrow your money stays at 5, hypothetically, one is going up and one is remaining the same, but it gets even better. So that's why taking loans from your policy makes a ton of sense. It allows your money to earn uninterrupted compounding interest. Now, let me pause real quick because I love that word, uninterrupted. And a lot of people, when they're watching these videos, they want to learn more. So I've got a solution for that too. Right here, click that subscribe button. Yep, just smash that subscribe button. And right above this little bell, whoa, coming in hot. You see that little bell up there? Smash that bell so that every time we put a new video out, you're notified. Now, go long. Good catch. You know, if only Josh Allen could throw it into the end zone like that, we would have a winning, well, it's too early to tell. We might just win the Super Bowl. Anyway, getting past football, let's talk about your private banking system. So now you have learned how you can earn uninterrupted compounding interest and take a loan from your policy, and that is the insurance company advancing your death benefits. So now that money's out there earning 12%. And over here, it's earning interest and dividends in the policy as well. But we're not done. When you make that 12% interest, where is that interest going to go? Well, if any of you thought, well, I'm going to put it in the bank. Why? You just created your own private banking system, so why would you put your money back in somebody else's bank? Wouldn't you then take the interest that your money's earning and put it back into your bank? I want you to think about this like a circle. Your money started on the left side of the circle with the deposits into your policy. We found a place for that money to earn a higher interest rate. So we took that money out in the form of a loan and we made it go out and work at 12%. Now it's on the other side. It's in the opportunity zone earning interest. Then we make interest on that money. Where do we want that to go? Well, back into our bank, the other side of the circle. So we bring it around the bottom part of the circle and it lands back in our bank as a loan repayment. Now, every dollar of that interest that you put back into your policy as a loan repayment is available the next day. If it was a car that you had bought, if you made a car payment back to your bank, every dollar of that car payment would be available the next day because you control your money and you are the bank. But think about this. Every time money goes back into the policy as a loan repayment, you're paying down the loan to the insurance company. And the insurance company is charging you 5% simple interest, but it's charging you 5% simple on the remaining balance. And if every month you're putting that 12% interest back in the policy, you're reducing that loan balance, which means your APR, okay, the amount that you're actually paying in interest, is slowly going down, while your money is slowly going up because of compounding. So one is going up and one is going down. Now do you understand why being your own bank makes a lot of sense? It's the exact same thing you're doing today, with the addition to changing where your money goes first and adding that step that I just mentioned called the infinite banking concept. So now, when people tell you that you're stupid for borrowing your own money when it is the money you've saved, you then can say, oh yeah, if only you understand the insurance company, well then you would have a lot more money and be a lot more financially secure because you will have become your own bank. Folks, when we're talking about loans, you've heard this before. Robert Kiyosaki talks about it. He said there's good debt and bad debt, right? When you take loans from the policy, that's not really even considered debt. It doesn't show up in your credit report. It doesn't affect anything. It's just less money that will be paid out the day you die. So these loans are very different than any other loan, but it's that mindset thing, right? When we think of a loan, we think loan, bad, payment, bad. But when you make a payment back to your bank, you keep all of that money. And the only thing the insurance company is going to charge you is that 5% or whatever simple interest your insurance policy charges. And I've never seen it any other way in all the years of doing this. The policy pays you more than what they're charging you in interest. So I hope you enjoyed this. And if you liked this video, you're going to love this one right here. It's called BYO Bank. We'll see you on the next one.